On March 23rd, a scene unfolded at the Bank of China branch on Tuanjie Street in Xilin Hot, Inner Mongolia. An agitated customer was trying to withdraw money. A bank worker who was taking money out of the box exclaimed, "There's no more money." According to inside sources, a customer had attempted to withdraw 60,000 yuan but was refused by the bank staff. The worker explained that if the money was withdrawn, the bank would no longer be able to operate. Despite this, the customer insisted on withdrawing the money, leading to the heated scene. It was clear from the worker's behavior that she was upset about the withdrawal request. A video circulating on Chinese social media shows another situation where a family member went to the bank to withdraw money for a patient's medical treatment, but faced repeated obstacles from the bank during the process. The frustrated customer filmed the encounter, questioning why they needed permission from both the bank and the government to withdraw their own money. I just want to withdraw my 25,000 yuan. It's been 20 minutes already, and the bank has called countless times to verify. They kept asking for details about my family member's hospitalization. I don't get it. Just because we're not in the hospital, does that mean I can't withdraw my own money? Why is it taking so long? Is this really how it works at the Bank of China? They can't catch any fraudsters, but they can still scam people however they want. Meanwhile, regular people have to keep getting their information verified just to take out money. I really don't understand. In addition, another full-length video of the bank's withdrawal process has surfaced, showing the difficulties a customer faced in trying to access their funds.
Ma'am, what are you using the 200,000 yuan for?
To buy a safe.
You don't need that much to buy a safe.
Can I just leave the rest in the safe? It's more convenient to access, and it works better than your bank.
Ma'am, you're just joking now. It's definitely safer and more convenient to keep your money in the bank.
Convenient? You handle business so slowly. I can't even come in for urgent matters. I took a ticket at 2 p.m. and it's not my turn until 4 p.m. There are 4 windows, but there's only one open. Are the other windows just for decoration? Your efficiency is terrible. One person working and the rest just standing around. Can't you see there are dozens of people waiting outside? I don't need your explanations. Every time I come here, it feels like you're treating me like a criminal. When I deposit money, you ask where it's from. When I withdraw money, you ask what I'm using it for. When I transfer money, you put limits on it. When I make small transfers multiple times, you say it's unsafe and force me to go to the counter to activate it. Now I'm starting to doubt if this money is really mine. Even Tang Sung's journey to the West wasn't as hard as me trying to get my own money.
We're doing this for the good of the account holders, with all the phone scams these days.
Then let me ask, who are you actually managing? You're not controlling the bad guys, but you are controlling the people who can't do anything. You constantly limit my withdrawals and lock my cards, but the scammers can still empty my account in minutes. The money from bribery and corruption flows overseas without anyone stopping it. You're focusing on the wrong things and letting the real problem slip through. Anyway, I've realized now, the safest place for my money is in my hands. I don't even know whose money it'll be if I leave it with your bank.
It's still your money as long as it's in your name.
If it's mine, then give it to me.
This is a large withdrawal. You'll need to provide the purpose of the funds.
I already told you I'm buying a safe. The rest is staying in the safe.
But you didn't make an appointment, so you can't withdraw it today.
Then I'll make an appointment now to withdraw it tomorrow.
That's not guaranteed either. It depends on whether the bank has enough cash tomorrow. How about you leave your contact information and we'll call you once we confirm.
The woman in the video ultimately did not manage to withdraw the money she wanted. According to reports from international media, within the first week of 2024, several Chinese banks announced reductions in the daily transaction limits for mobile banking users, lowering the limit from 500,000 yuan to 2,000 yuan. On January 8th, Anhui Chongcheng Rural Commercial Bank announced via its official WeChat account that starting January 20th, the daily and single transaction limits for some customers' mobile banking accounts would be reduced to 2,000 yuan. This is not the first bank to reduce its transaction limits. Recently, the Bank of China's Tianjin branch, Hecheng Rural Commercial Bank, and several other banks also issued similar notices, targeting personal mobile banking customers who had not made transactions in the past year and had daily limits above 50,000 yuan. The banks explained that this move is aimed at enhancing the security of customers' funds and preventing telecom fraud. However, many customers feel that the banks are intentionally creating obstacles to prevent the flow of funds. Since 2024, several banks have reduced the mobile transfer limits, prompting numerous complaints from customers on social media. Many reported that their bank cards were limited without prior notice, preventing them from withdrawing or transferring their own money. Some users even found that they could not transfer as little as 1,000 yuan. One user shared, "It's so frustrating. My limit was set to 3,000 yuan. I went to the dentist recently and it wasn't enough. It was really embarrassing. I had to call someone to borrow money to pay. What if there's an emergency in the middle of the night? Will the bank open then?" Others believe that the restrictions on spending are hindering economic growth. "How can we do business with such low limits? In the past, I had to answer to my boss to earn money. Now I have to answer to a bank to spend it. This world has changed." These examples show that by 2025, it has become even harder to withdraw money from banks in China. Could the increased difficulties in withdrawing money indicate an economic crisis in the Chinese banking sector? Is it really true, as the worker claimed, that there is no money and that the bank can't operate anymore? On March 17th, China's National Financial Regulatory Admission released new data, showing that as of December 31st, 2024, there were 4,295 legal banking institutions in China. Looking at official historic data, in late 2021, the number of legal banking institutions was 4,602. In 2022, it was 4,567, and by the end of 2023, it was 4,490. In 2024, the number had fallen to 4,295. This means that between 2022 and 2024, 307 banking institutions have disappeared. In 2024 alone, 195 institutions ceased to exist, marking the highest exit rate in nearly 3 years. According to an announcement from the Henan Rural Commercial Bank, 25 institutions, including the Henan Rural Commercial Union Bank and rural commercial banks from Zhengzhou, Xinxiang, Puyang, Jiyuan, and Xiangyang Lifen Village Bank, have been merged to form the new Henan Rural Commercial Bank. This means that 24 banking institutions will lose their legal status. In addition, the approval of the Inner Mongolia Rural Commercial Bank's establishment means that another 119 banking institutions will lose their legal status. As of 2024, more than 75 village and town banks were merged, and over 55 were acquired. An anonymous analyst from a brokerage firm specializing in the banking sector stated, "It's believed that many small banks will continue to be absorbed and merged this year." An article published by The Economist last year also noted that, even during the most severe periods of the deposit loan crisis, China had never seen banks disappear at such a rapid pace. The article predicted that the Chinese government would speed up the absorption and merger of smaller banks. According to S&P Global, these merger projects are expected to take 10 years to complete. The prediction is proving accurate. From the beginning of this year until February 26, 37 banks in China have been merged or dissolved, compared to only 2 banks during the same period in 2024. The reasons behind these bank closures or acquisitions were discussed in a December 2024 article from Chinese media Entrepreneurship Life Guide. It stated that the surge in bank deregistrations indicates that these smaller banks are facing issues such as a shortage of funds and poor management. Additionally, problems in risk control and credit management have made these banks more vulnerable in a declining economy. At the same time, large financial technology companies, with their resources and technological advantages, have taken a portion of the market share, increasing pressure on small banks to survive. Moreover, many small banks have loaned money to real estate developers and local governments, becoming deeply entangled in China's real estate crisis. In recent years, several small banks have revealed that up to 40% of their loan books consist of non-performing loans. Secretary General of the Asia-Pacific Elite Interchange Association, Wang Zhisheng, stated that the restructuring or dissolution of small banks might be a result of the Chinese government attempting to address the systemic financial crisis triggered by the real estate sector. To some extent, it also reflects how the economic crisis has reached a point where such rapid measures are necessary. Wang added that the hidden local government debt, which Chinese authorities have been unable to resolve, is tied to the real estate bubble and uncollectible loans. These issues have become ticking time bombs for banks, further contributing to the financial crisis. Therefore, the merger or dissolution of small banks is merely a slow form of euthanasia. In addition to these smaller banks, China Ping An Bank, which is globally recognized for its authority and has 126 million retail customers, has recently experienced a shocking situation. According to Ping An Bank's 2024 annual report, the bank achieved a total operating revenue of 146.7 billion yuan in 2023, a decrease of 10.9% year-on-year. It reported a net profit of 44.5 billion yuan, down 4.2% from the previous year. By the end of 2024, the bank's total assets stood at 5.7 trillion yuan, with a non-performing loan ratio of 1.1%. Currently, Ping An Bank's non-performing loan rate for personal loans has risen to 1.4%, with the non-performing loan rates for mortgage loans, consumer loans, and business loans all increasing. The bank's annual report also shows that in 2024, Ping An Bank received a total of 201,905 complaints, including those from regulatory agencies, the 95511 hotline, credit card center channels, and other in-house channels. As of March 18th, over 6,900 complaints about Ping An Bank credit cards were found on the Black Cat Complaints Forum, with issues such as aggressive debt collection and unauthorized charges. The report also highlights that Ping An Bank saw a double decline in revenue and net profit for the first time in 25 years. A closer look at the data shows that the bank's net profit growth in the first 3 quarters of 2024 was 2.3%, 1.9%, and 0.2%, but it plummeted to negative 4.2% in the fourth quarter, indicating a sharp decline in performance during that period. For example, Ping An Bank's 2 main drivers of retail business, retail loans, and wealth management both faltered last year. From a professional perspective, the core of Ping An Bank's retail loan business is net interest income. In 2024, the bank's net interest income was 93.4 billion yuan, a drop of 24.6 billion yuan compared to 2023, reflecting a year-on-year decline of 20.8%. Moreover, the bank's personal loan balance dropped sharply by 10.6% compared to the previous year, losing over 200 billion yuan, signaling that the bank's risks are becoming unmanageable. Additionally, the proportion of credit and other asset impairment losses under retail financial services compared to pre-impairment operating profit increased from 89.5% in 2023 to 99% in 2024, showing a worsening trend. After the release of Ping An Bank's annual report, some investors expressed disappointment with the performance of this national joint stock commercial bank headquartered in Shenzhen. On March 20th, Chinese media reported that the annual report was a shock to the bank's 480,000 shareholders. In China, many banks are established to serve small businesses. In the country's poorest regions, banks burdened with bad debt are not only struggling to offer new loans to businesses, but may also harm the fragile economic growth of these areas. Among these non-performing loans, personal bad loans are particularly concerning. The sharp rise in personal bad loans has become one of the biggest headaches for financial institutions in China. According to data from the Banking Credit Asset Registration and Circulation Center, an average of 3 non-performing loan projects were added every day in 2024. The total amount of bad loans, including principal and interest, transacted during the year reached 225.8 billion yuan, an increase of 81% compared to 2023. This is the highest level since the launch of the batch transfer pilot program for bad loans in 2016. Of this, personal bad loans accounted for 70%, totaling 158.4 billion yuan, a year-on-year increase of 64%. Looking at the structure of personal bad loan assets, for example, in the fourth quarter of 2024, personal consumer loans accounted for the largest share at 66%, followed by personal business loans and credit card overdrafts. According to data from the People's Bank of China on household loans from 2019 to 2024, it's clear that the consumption power of the primary borrower group, middle and higher income individuals, has been significantly weakened by debt. In fact, it can be argued that China's nearly 2 decades of rapid economic growth were largely driven by individuals, businesses, and the government borrowing against future wealth. The growth and expansion of banks followed a similar pattern. It is possible that the personal, corporate, and government sectors have drained the banks to the point where they no longer have the funds to operate. At the same time, while small and medium-sized banks struggle to survive and cannot even release depositors' funds, some banks are participating in investments related to CCP General Secretary Xi Jinping's technological leap forward, pouring significant amounts into it. Reuters reported on March 6th that Zheng Shanjie, the director of China's National Development and Reform Commission, announced at the economic press conference of the third session of the 14th National People's Congress that China will establish a national venture capital guidance fund of 1 trillion yuan to support tech startups. It will focus on sectors like semiconductors and renewable energy. Following this, on March 12th, Bank of China announced it would expand its tech innovation fund to 50 billion yuan, creating a multi-level and multi-dimensional investment layout. On the same day, Industrial and Commercial Bank of China, ICBC, announced an 80 billion yuan technology innovation investment fund to support the development of tech and emerging industries. It's rather ironic that on one hand, depositors cannot withdraw even 25,000 yuan, while on the other, ICBC is investing 80 billion yuan. These banks are participating in CCP General Secretary Xi Jinping's tech power movement, which aims to challenge the United States in the tech sector. His goal is to surpass the US and become the global leader. His underlying motivation is to prove to the world, especially China's 1.4 billion citizens, that under his leadership, China is capable of catching up with and even surpassing American technology. The cost of this ambition, however, is that countless depositors cannot even access their own money. Now, with the banks facing financial difficulties, high unemployment, and the impact of U.S. tariffs, the CCP continues to make questionable decisions. The CCP's General Office and the State Council recently issued the Special Action Plan to boost consumption, which again mentions that commercial banks can implement differentiated credit policies based on customers' repayment abilities and risk levels. In simple terms, for customers with good credit and large consumption needs, the upper limit of personal consumption loans can be increased from 300,000 yuan to 500,000 yuan, and the upper limit for personal internet consumption loans can be raised from 200,000 yuan to 300,000 yuan. The so-called consumption boost from the CCP has chosen loans over direct financial assistance, opting for psychological stimulation instead of material or monetary support. Furthermore, the CCP has made a strong move in personal consumption loans. Since the beginning of the year, the interest rates on personal consumption loans from major commercial banks have repeatedly hit new lows, falling below 2.6% and then 2.5%. For example, in early March, Suzhou Bank introduced a consumer loan product with an annualized rate as low as 2.58%, setting a new industry record. On March 18th, Beijing Bank, Ningbo Bank, and other banks reduced their interest rates on consumption loans to as low as 2.5% annually, with some offering rates as low as 2.49%. On March 19th, Beijing Bank offered some customers fixed-rate consumption loan coupons with an interest rate of 2.5%. Some customers shared screenshots showing that their consumption Jingyi loan, originally approved at an annual interest rate of 5.7%, received a 2.5% rate coupon. This means that in less than 2 weeks, the interest rates in the consumer loan market have hit new lows. The direct impact of these lower loan rates is a decline in banks' profitability. However, despite the decline in loan rates, the demand for financing in the real economy has not rebounded significantly, and banks are facing greater pressure in their net interest margin. This further confirms that while financial institutions have attempted to stimulate domestic demand by lowering loan rates, the actual effects may be limited. For individuals, businesses, and banks, as well as the overall decline in China's economy, the CCP's persistent use of flawed stimulus measures highlights a fundamental issue. The CCP's primary focus has always been to extract more from the people, rather than truly promoting economic growth. As economist George Magnus, researcher at the China Center at Oxford University, stated, "It's not low confidence that's hindering China's households and causing weak consumption. The vast number of consumption plans from the Hu Jintao and Wen Jiabao era proves this. The real reason is the government's own macro and industry policies, which have led to weak consumption and, in turn, low confidence. The government seems unwilling to commit to investing more based on the current situation. Moreover, most of the proposed measures are focused on increasing the supply of consumer goods and services, which is not the real problem in China today. The government has misdiagnosed the issue."